At 9:29, two trading robots look identical. Same chart, same account size, same market. Then the spread suddenly widens. One robot opens the trade anyway, the other does nothing. And that refusal may tell you more about institutional precision than 100 winning screenshots ever could. This is a hypothetical test, but it exposes a very real problem in automated trading. Most people judge a Forex EA robot by what it does when everything is working. The signal appears, the order opens, the trade moves into profit, the dashboard turns green. That is the easy part. The harder question is what happens when the market stops behaving like the data used to build the system. Imagine the first robot has one instruction. When price crosses a certain level, buy. The level breaks, so it buys. Technically, the robot followed its algorithm with perfect discipline. But the spread is wider, the fill is worse, volatility is accelerating. The trade begins with a larger disadvantage than the strategy expected. The machine made no emotional mistake. It simply executed a weak decision perfectly. The second robot sees the same signal, then checks the conditions around it. Is the spread within its allowed range? Is the price still close enough to the intended entry? Has exposure already reached its limit? If one critical condition fails, the order is rejected. Nothing happens on the screen, no dramatic entry, no instant profit, just a system protecting itself from a trade that no longer matches its assumptions. That is the first important difference between automation and precision. Automation means a machine can repeat an instruction. Precision means the instruction is clearly defined, the conditions are measured, and the system knows when execution is no longer acceptable. Adding the letters AI does not automatically create that precision. Some expert advisors use fixed rules. Some adapt parameters. Some may use statistical or machine learning models. Those are very different systems, even when the marketing gives them the same label. So the useful question is not, does this robot use AI? It is, what decision is the technology actually making? Is it identifying a setup, filtering bad conditions, adjusting position size, or is AI-powered simply describing ordinary automation in more impressive language? Now the test gets harder. Both robots take a valid trade, and both lose. The loss itself proves almost nothing. Every strategy can be wrong. What matters is what the system does next. Does it keep the next trade at the planned size? Does it increase exposure to recover faster? Does it open multiple positions that are effectively the same bet? Does it continue trading after the account has reached a predefined limit? This is where impressive backtests can become irrelevant very quickly. A smooth historical curve cannot protect a live account from a missing limit, a coding error, a changed broker condition, or a user who selects settings the strategy was never tested to handle. Machines do not get tired, but they can receive bad data. They do not feel fear, but they can follow bad logic. They do not revenge trade, but they can repeat the same flawed action faster than a human ever could. And institutional trading is not powerful because institutions own magical entry signals. Their real advantage often comes from the machinery around the strategy: data quality, execution controls, independent risk limits, monitoring, logs, testing, and people responsible for stopping a system when its behavior changes. A retail robot cannot become institutional simply by borrowing that word, but it can borrow the discipline behind it. That means the most revealing evidence may be boring, a clear explanation of when the system should not trade, risk that can be understood before the first order opens, records that show entries, exits, errors, and rejected orders, testing that includes unfavorable periods, not only the cleanest section of history, and controls that remain controls when the strategy is losing. Now return to the two robots at 9:29. The first one gives the viewer what they expect: action. The second gives the account what it may actually need: restraint. You cannot know from that single moment which system will perform better over time, but you can learn which developer has thought beyond the entry signal. If you are comparing automated systems and want more practical breakdowns of how Forex robots behave beyond the sales page, join the community through the link in the description. The smartest trade an automated system makes may be the one it refuses to take.